Today I want to show you how to buy a rental property without leaving any of your own money into the deal. Keyword, leaving any of your own money into the deal, or otherwise known as, what I like to call it, the slow flip. So I'm going to break down here real life numbers from a rental property in Philadelphia, Pennsylvania, where I utilize this strategy. Purchase price, $200,000. Renovation, $100,000. All-in cost, obviously $300,000. But the big thing here is the after repair value of $400,000. Now this is a very average deal. This is not a home run of a deal for investors. This is something that a beginner can take advantage of. You might not find that much of a spread on the MLS, but you don't need an exclusive list of properties that are only available to investors that have connections within the city. I can tell you from experience. So now with your new after repair value, you're going to purchase this property. You're going to renovate it, and you're going to put tenants into it. And then you're going to do a refinance, a cash out refinance, and get a new appraisal on the property, which is hopefully around the $400,000. But your new loan is going to be $320,000. And we did a video on this before, but the reason is 80% loan to value. Banks are only going to loan 80% loan to value on all investment properties. So a new bank is going to give you, this is your first bank, this is your second bank. Your new bank's going to give you $320,000. So that is a $20,000 spread or difference from your all-in cost, whether it's your down payment and what you purchased it for and your renovation loan, which I'm going to get into in a second. You have a spread of $20,000 difference. But you have to hold on a second, because when you do a refinance, there are some fees associated with it. The best part is when you do a refinance, the fees are a lot less than where if you were to sell it as a flip. If you're a seller, you're doing real estate transfer tax, you're doing real estate agent commissions, you're roughly looking at about $5,000 in closing costs, which is title insurance and origination charges and your escrows. So roughly $5,000, so the difference between that would be $15,000. So this $15,000, and these are real life numbers, is exactly what you're going to have left over in profit, extra, in your hand, cash from before you started, before you even put the money down. So now you have $15,000. You own this rental property. This one cash flowed $500 a month. You now have a property in Philadelphia that's appreciating 4 to 5% a year conservatively. And you also could take advantage of a plethora of tax advantages to include depreciation. And now you can move on to your next one. That's why I call it the slow flip. Takes a little bit longer, 6 to 8 months, depending on the renovation. Now, I'm sure a lot of you have a lot of questions out there. I'm not really sure how to get started. I don't have a lot of money. I don't have 20% down, plus the renovation costs. You're looking at $140,000, $150,000, and I get it. But I'm here to break it down for you in different chapters, because it's not as bad as it might seem. You do need to come up with a 20% down. You need to borrow from a friend if you don't have the money, borrow from a family member, tap into your 401k, sell stock. You have to have some sort of skin in the game. All these gurus out there, these books and these other videos where you can buy a rental property or buy a house with zero money down does not exist. I'm here to tell you, you have to have some sort of skin in the game. And then the bank, which I'll get to in a second for the renovation, wants you to have skin in the game with a percentage down. So you need to put 20% down, and then there's going to be probably about $10,000 in closing costs when you purchase this original investment. Now the easier part for financing, I should say, is the renovation. There are a lot of commercial lenders out there that have no problem lending 100% of the construction costs on a deal like that has a spread like this, on an average deal where you're purchasing it for 2 and the ARV is around 400. And the reason I say 100% of the construction cost is because the bank doesn't want you to not finish the construction project. So they want to loan 100% of the construction costs. I just did one a couple months ago. I'm speaking from experience, and I'm also working with a lot of buyers as a real estate agent that are also utilizing this strategy. So I'm working closely with a lot of lenders and title agents out there. $15,000 left over afterwards. I also recommend for beginners out there just to get started on this. This is the easiest way to get started. I'm sure you guys have a lot of questions. Feel free to comment below, direct message me. And as always, thanks for stopping by.